Hello everyone, and welcome back to the Quant Lab. In technical analysis, the most difficult psychological hurdle for any trader is not finding the entry. It is managing the exit. Human emotion causes traders to cut their winning trades too early out of fear and hold on to their losing trades too long out of hope. Today, we are going to study an algorithm designed specifically to ruthlessly manage your exits and eliminate human emotion, the parabolic SAR, or stop and reverse, developed by J. Wells Wilder. The SAR is a virtual and mathematical tracking system. It plots a series of dots either below or above the price candles. It looks like this. If the dots are below the price, like this, you are in a long position. If the dots flip to above the price, you are in a short position. So sell it like this. But what makes this tool brilliant is the acceleration factor, which is in the math formula, the alpha t right here. When a new trend begins, the SAR dots provide a wide, generous stop loss to let the asset breathe. However, every time the price achieves a new extreme high, the mathematical acceleration factor increases. The dots begin to curve upward parabolically, aggressively tightening the stop loss the further the trend extends. It is mathematically designed to lock in your profits and force you out the moment the macro momentum fractures. Now, the Parabolic SAR is a very special framework. Unlike the oscillators and geometric tools we use intraday during our afternoon golden window, the SAR can be deployed as an entirely independent, standalone system without looking any other indicator. But there is one absolute non-negotiable rule. Execution occurs strictly at the 4 p.m. market close. Why? Because intraday price action is volatile, a stock might briefly spike and cross the SAR dot at noon, but pull back by 3 p.m. The definitive signal, the mathematical flip of the dot, is only permanently locked in when the daily candle finishes printing. If you trade the SAR, you do not anticipate. You execute mechanically at the close. Let's look at the daily chart of S&P 500. Okay, so to use this indicator, you just need to search SAR from this indicator, and then you just click it, and you can see these dots. And let's see this mechanical execution in action. On this left side of this S&P 500, the market enters a powerful macro uptrend from here to here. The SAR functions flawlessly here. On April 1st, we can see that the dot flips to below that K line, and you can see, the closing price right here. So on April 1st, the dot flips below the price, triggering a mechanical long entry at 6,575. For the next month and a half, the algorithm does a heavy lifting. You do not think, you do not panic, you simply let the dots trail higher. Finally, on May 18th, the price crosses below the dot, forcing a mechanical exit at 7,403. You just captured an 800-point macro wave with zero emotional stress. However, the SAR poses one fatal mathematical flaw. Because it is a continuous algorithm, it must plot a dot every single period, meaning it is always forcing you to be in the market. Look at the right side of here. The market enters a choppy sideways consolidation. The algorithm generates a false long entry signal on May 22nd at 7,473. The market goes nowhere, chops around, and forces a stop loss exit on right here, June 5th at 7,383. This is a losing trade. And let's get back to the lecture. And we have seen that for the consolidation market, the SAR does not work pretty good. And it only works actually for the top 250 companies of S&P 500, which means that the market capitalization should be at least 35 billion. And also the asset must demonstrate stable, positive quarterly profitability, and also never deploy SAR on low float stocks, pre-earning growth stocks, new listed IPOs, etc. And hence, there are a lot of constraints on using this SAR. So be careful that when you use it, it should satisfy these conditions. In quantitative finance, we call the previous one the Whipsaw Tax, for not earning money in this consolidation market. If you are going to use the SAR as a mechanical standalone system, you must accept this tax. You will take strings of small, frustrating losses during sideways market. You do not tweak the system, you mechanically accept the whipsaw tax, knowing that the strict rules of the algorithm mathematically guarantee you will eventually catch the entirety of the next massive macro trend. And that's all for today's lecture. See you in the next one.